Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically we'd see the lovely smiling face of Mr. Michael Becker, but in the house today, the professor himself, Mr. James Eng. James, how are you?
Great. Thanks for having me, Paul.
You have been on fire and extremely busy. Tell me a little bit about what you're closing out in the field these days. Tell me what type of transactions. Give people just kind of an insight about what you're seeing in the Old Capital world.
Yeah, I mean, in the first quarter, Freddie and Fannie were still very competitive, right? So we're closing Fannie Mae loans, Freddie Mac loans, Freddie SBL loans, but we're starting to quote a lot more bridge loans. And so what we're seeing is bridge loans are sort of like a whole different animal. And you just have to know what you're getting into to some extent. But the bridge lending environment has been super competitive. And what that means is as bridge lenders compete with each other, their interest rates get lower and lower. And so I was just talking with an owner this weekend, and he couldn't believe the pricing on bridge lending compared to Fannie and Freddie. And so, bridge lenders are getting into LIBOR plus, 3.25, 3.5. And so your all-in rates are under 4% on a bridge loan. And Fannie and Freddie are essentially at the same spot. And so that is probably the biggest change in the last couple months that we're starting to see more and more of.
Yeah, what's interesting about that, and James is right on point, is that non-recourse bridge lending was not, at this time last year, was not really available. And then all of a sudden it popped up back again in, say, August or September of last year, and now it's going full guns. And non-recourse bridge lending is a little bit different from like a bank loan because bank has regulatory approvals. They have to kind of follow the government's rules of what they can allow and what they can't allow in some of these transactions. But a bridge lender that does non-recourse, that's part of a debt fund that's doing this type of stuff, they only kind of have their own rules. And it would be like the same of like you, the listener, James and I coming together, just saying, hey, listen, I got $100 million right now and I want to lend it out to people because right now I'm only making less than 0.5% of my money and I want to get it out into the marketplace and let's just get it out there. So there's really no rules, so to speak, on that. And so what you're seeing is anywhere from 65, then it became 70, then it became 75, became 80, and up to maybe some cases up to 85% in leverage in some of these transactions. So that's a lot higher than Fannie and Freddie. And the rates right now are a lot lower, so to speak, than Fannie and Freddie. But, and there's that big but, is that these loans are not long-term loans. They're not 10 or 15 or 20-year terms. They are, how long, James?
2 to 3 years. And
yes.
So they might put some extensions on there, but 2 to 3 years is the initial term.
If someone wants to try to get the 80% or even higher leverage, what are the things that underwriters looking for? The approvers of these non-recourse bridge loans, what are they looking for? What are some of the what's some of the feedback that you're hearing of what can get you higher leverage and what's going to get you lower leverage?
I mean, these bridge lenders have a choice to some extent. Number one, they're going to start with the property, right? So they're looking for newer quality assets. So if you're buying something in the 80s or 90s or 2000s, they'll go higher leverage for you. If you go maybe in the 60s or 70s, it might be 75%. So that's number one is the property. And then number two is really the market. So if you're in a primary market, you might have 10 guys bidding on a deal. If you're in a secondary or tertiary market, maybe 2, 3, 4 hours away from Dallas or Austin, then you're probably going to be in that 70 to 75% range because you're only going to have 1 or 2 guys bidding on those types of properties. And then the third thing really is your experience. So have you done this before? Do you own anything in this market? Can you show me sort of before and after of some of your deals that you've taken full cycle? And those 3 things really determine, number one, your leverage, but then also your pricing on these bridge loans.
So let's follow up a little bit more because I think this is important too. What's the threshold for bridge loans? And let's kind of go through that, because let's say I have a $2 or $3 million transaction. I'm trying to do a bridge loan. Can that be done?
It can be done, but it'll be more expensive. So usually the threshold, I would say the first threshold is right at $5 million in loan amount. And then the next one is probably 10 million. And so as you go up in loan amount, there's more and more people who actually want to do that deal. And so when I was sitting at GE, we might have had 10, 15 guys across the nation. So we weren't doing 5, 10, or even $15 million deals. Everything we wanted to do was really 20 million and up, because we only had so much capacity and we could only do 20 loans. And, these guys would rather do $20, $50 million loans than $25 million loans.
That's right. And then probably one of the bigger differences too is, are these bridge loans requiring the sponsorship or the sponsor person or the people in the front of the cockpit of the airplane, people that are making the decisions, are they asking for lots of equity that out of their pocket into the transaction? How does that work?
I mean, the more equity, the better. What we're seeing is it's similar requirements to Fannie and Freddie, probably 5 to 10% of the equity. The challenge sometimes is you're taking an acquisition fee or some other fees. They really want to see net of all the fees you're taking, how much cash are you going to have in the deal? And anywhere from 5 to 10% is what we've been seeing.
Yeah, again, you personally having money in the deal, the people that are in the cockpit, so to speak, the people that are signing on behalf of the rest of the partnership, the people that are sitting in the back of the airplane drinking their Coke and chewing on some peanuts. They don't care very much about those guys, but they want to see who's in the cockpit, who's putting their actual cash into the deal that's on the hook. That's kind of the fiduciary for the rest of the people in the airplane. So I think that's very important to understand some of the rules. And again, if you want to get into more detail, James and the group at Old Capital can be more than happy to kind of go through that. Last comments at all, James? Anything more to add to it?
It's sort of like the pendulum swinging back and forth. We've seen bridge lenders come in sort of showing their cards very early in the beginning of 2021, saying, look, we're going to have higher leverage. We're going to have lower interest rates. But Fannie and Freddie are not going to sit there and just take it in the chin. They are reducing their reserves. They're reducing their spreads. They are becoming more competitive. And so I think what you're going to see is Fannie and Freddie are going to be back at the table very shortly in terms of leverage, in terms of interest rates, in terms of IO. And I think people are just going to have to wait a little bit, and Fannie and Freddie will be just as competitive.
Some great information, James. Recently, James had a conversation with Clay Allen on our team about looking into another area of the country that we do a lot of lending in, but you may not have a lot of information on. So, James, tell us a little bit about what's going down in Florida in your conversation.
Yeah, so we brought in a listing broker who has been based in Tampa now for about 10 years and really just talked to him about, let's call it the Florida Triangle, Jacksonville, Tampa, Orlando. And I actually haven't done a lot of business in that space. Clay Allen out of our Atlanta office has done a lot and managed a lot of properties there. So him and Jad really go through it together and talk about what people like about it, right? And so we see the number of people moving to Texas, the number of people moving to Florida, whether it's businesses, whether it's just people who want a warmer climate and more affordable housing. And so they're seeing just them talking about those markets and getting an understanding of them is what you'll hear in this podcast.
That's fantastic. So without any further ado, let's get right on to the interview with Clay Allen and James Zhang. And let's talk a little bit about Florida.
Hi, this is James Zhang with Old Capital. And today I am joined by Clay Allen and Jad Richa. So Jad, maybe to kick it off, give us a little bit of your background, sort of where you sit. I'm in Dallas. Where's your office, Jad?
I'm in Tampa.
Tampa. All right. So today we're going to do sort of a deep dive into the Florida market. And so a lot of investors from California are coming to Texas. A lot of investors from New York are going to Florida. And you're just seeing a huge influx of not only population and jobs, but investors. So we wanted to have Jad on to really give us insight into what he's seeing in that market. But before we do that, Judd, maybe give us a little bit of your background. And I always love to hear how people got into the business. So maybe give us a little insight on how you got here.
Okay, great. Thanks for having me, guys. So I moved down to Tampa in 2005. I had previously worked in professional sports. I worked for the Cleveland Browns, and everybody who hired me got fired. So I got thrown out the door with them, and I got a 6-month severance package, and it was February in Cleveland. And so I packed everything I had in my Chevy Impala and pointed the car south and ended up in Tampa where my cousin lives, and said, well, I'll just figure it out once I get there. And 16 years later, we're still going. So originally when I got down here, I tried to stay in professional sports and worked on the representation side of the business. And it just kind of wasn't getting me to where I wanted to get to career-wise. So I simultaneously went out and got my real estate license and started flipping houses a little bit, and did that until about 2008 when the market crashed. Kind of had a lifeline thrown to me for a couple of years on the sports side again, just to keep paying my bills while I was trying to figure out how to make a buck in 2009 and 10. And then 2010, the opportunity got to get back involved in real estate, did some general commercial brokerage and investing. And then in 2012, decided multifamily was the place I wanted to be, and started a small investment sales group with another guy under just a Sperry Van Ness flag, just to kind of get out of the ground and get going. 2014, I met Brian Ford and Bo McIntosh, the founders of Capstone Apartment Partners, at the NMHC conference in Boca. And we started conversations with them. They were looking for growth into Florida, and we were looking for, a better multifamily platform. And so we were able to put together a marriage that's really worked out tremendously. We were effectively the first office outside the Charlotte office of growth for Capstone, and spin it forward now 7 years. We have 12 offices in 8 different states. We, in 2020, sold over $1.5 billion in transactions and in excess of, I believe, 25,000 units. And Capstone is currently the largest privately owned multifamily investment sales firm in the country.
So when a lot of people look at Florida, I guess, how would you describe it to a Texan? If I flew in to meet you, you said you're in Tampa, right?
Yes.
All right. So you come into Tampa, and maybe talk about sort of the four major markets in Florida that you guys cover. And then how would you explain those markets to somebody? Because Dallas is very different. I grew up in Houston, but then I moved to Dallas. I went to school in Austin. Each city has its own unique sort of vibe and business climate and residential feel, and what type of people live there, right?
Sure.
So maybe take each one of those sort of major markets within Florida and give us a little history or summary of each one.
Okay. So Jacksonville is, North Florida, Southern Georgia-ish a little bit. So it feels a little bit more like the South than Tampa and Orlando does. And it kind of operated that way up until about a couple of years ago. In the last 2 years, we've really seen an influx of capital from New York and out of state money, where historically that's been, focused on Tampa, Orlando, and then Southeast Florida, which we don't really cover. So I won't spend a lot of time talking about it, but it's definitely growing up. And I feel like from a apartment fundamentals and metric standpoint, probably drafting 18 to 24 months behind the Tampa and Orlando markets. I think that gap is closing a little bit. Tampa, where I live, is a rapidly growing market, and I want to say a rapidly diversifying economic base. So we're not really driven by tourism down here. I mean, I think we've got a pretty good tech incubator type economy burgeoning down here, healthcare, financial services. We've got the port. So the logistics corridor between here and Orlando is rapidly expanding. Culturally, Tampa's a good time. There's a lot, Tampa's kind of I think has an older, more native Tampanians, I guess, here than there are native people from Orlando. So you do get a little bit of that kind of native feel, Cuban, Spanish, Italian immigrant, flooded here about 100 years ago. And then Orlando to me is kind of two economies. You have South Orlando, which is the Disney and tourism economy. And then you've got, mostly healthcare driven north of that. Orlando feels very transient and very commercialized to me. I'm certainly biased to Tampa over Orlando, but all the markets are great. And, the job growth, population growth down here are just booming.
So touch on Tallahassee, because you mentioned Tallahassee.
Yeah. So Tallahassee's Tallahassee's sort of kind of like a sleepy little market, about 500,000 people, but it's the state capital and it's got a big university. And, a while back when we were just trying to really expand our brand and find a way to compete with some of the bigger shops, we said, let's just go where there's nobody else. Nobody has an office in Tallahassee and neither do we. But, I just kind of showed up and said, hey, we're here. Who wants to do some business? And we've been able to, sort of take one deal and turn it into another. And, we've effectively sold 900 or 1,000 units up in that marketplace over the last few years and really been one of the bigger investment sales groups operating in that market. It's not a high velocity market, so you're kind of a big fish in a small pond up there, but it's kind of a steady Eddie government and education backed market. So
when people look at Florida, would you say your primaries are sort of the Tampa, Orlando, out of these four? The primaries are the Tampa, Orlando, and then Jacksonville is maybe secondary. Tallahassee is maybe that tertiary.
That's right.
Okay.
That's right. Okay. And there will be, there's just, if 100 people look at our Tampa and Orlando deals, 95 of them will look at Jacksonville and maybe 70 of them or 60 of them will look at the Tallahassee listing. Okay.
And then give us sort of rough pricing. You can either do it per unit or cap rate.
Everything's a 4 cap. Everything's a 4 cap.
Doesn't matter. A, B, C, everything's a 4 cap. But price per unit for, let's say, Dallas, like A stuff in the suburban areas is maybe 200 a door. B's are maybe 100, 130, 150. And then C's are maybe 100 a door. Is that similar pricing in Florida, or where do you see pricing right now across? Let's just maybe talk Tampa, Orlando right now.
Yeah. So, I'm kind of joking that everything's a 4 cap, but not really. There's very little spread between A cap rates and C cap rates these days. It's all driven by the demand. A C class deal, B, C class deal in well-located parts of Tampa are probably 135 to 150 a door, maybe 160, 70 a door, just depending on, suburban or infill or, the vintage, the rent stack, that kind of stuff. Class A new construction product is rapidly increasing. I think about 12 months ago now, I'd say deals are in the 220, 230 a door range. We are closing a deal next month in South Orlando, Kissimmee market. That's going to be in the 255 a door range. And we're hearing a lot more of that 245 plus pricing expectation on those trades rather than 220 a door, which it was about a year ago.
Right. And then I'll kick it over to Clay now. Maybe Clay, talk about what you're seeing. You've closed some deals in Florida. Sort of why are people going to Florida, number one? And then, talk about what markets they're looking at too.
I would say we closed some deals in Orlando with my former company, and we like the Class A stuff. And to Jad's point, there's not much of a spread between the Class C's, Class B's, and A's. And so we're just kind of snapping up the A's because, why not? So just very transient market. Like you said, Jad, Orlando is great area for the most part. But I did want to ask one thing for you, Jad, with Jacksonville and Tampa. In the past, it's been, I think institutions kind of shot away because of the back office employment as well as military. Is that still the case today?
We're not really seeing that. Definitely not in Tampa. And, Blackstone just bought a $75 million Class A transaction in Tampa. So, that's as institutional as it gets, right? And there's about a 300 unit deal. I'm just kind of going off memory. Jacksonville, we're they're probably still a little bit behind, but there's definitely, it's changing rapidly. I mean, Mayo Clinic is in Jacksonville, and there's a lot of hospital and like medical jobs coming in. And it's just, all the economies down here are really getting a lot more diversified than what you've historically thought of the Florida economies would be.
Well, we're seeing too a lot of financial services coming. And we have seen that in Jacksonville, correct?
Yep.
I mean, in the past, but more recently, you're hearing more investment banking jobs, maybe moving down to Southeast Florida.
Yep.
So that's certainly a driver, especially in the age of COVID, I guess.
Yep. And you're seeing even some of the secondary Florida markets really see rapid job growth. Like, for example, a place like Melbourne. Melbourne has, really the space business, and a lot of high paying engineering type jobs are coming in, and the rents in Melbourne and the values in Melbourne are skyrocketing. 80s deal, I forget the name of the deal, but just transacted for like 185 a unit in Melbourne, which is Space Coast.
Yeah, that's amazing.
Yeah.
So if let's say there's someone from the outside of Florida, they're looking to come into the state, they're maybe looking for 50 to 150 units, and they want to break in, but they're going to have a tough time in Tampa, Orlando, maybe Jacksonville. What are some markets that you would point them to where they might have a better chance at taking down a deal?
So there are no secrets in Florida anymore. I mean, every market's been covered. I would say Melbourne is a great market because it's growing in that whole kind of Palm Coast, East Coast area over there. I think is going to see some rapid growth. Sarasota, Bradenton are probably the two of the fastest growing counties in the country. You're not getting any additional yield for going into some of these submarkets. I mean, the cap rates are effectively the same across the board. I'm big on Lakeland. Mm-hmm. I think the, Amazonification of the economy and being along the logistics corridor is going to position that market for explosive growth over the next 10 years, especially when you think about the fact that, like, if you're smack in the middle of Tampa and Orlando, and as those markets become less affordable, commuting 30, 40 minutes is going to be more palatable, and you'll be able to fill that gap with housing in there.
Right. And that's the I-4 corridor that people often reference. It's very high growth between Tampa and Orlando.
Which at one point in time, we were talking maybe 25% of all of the population growth in Florida was concentrated I-4 corridor. I don't know if that is still the case just because of the growth that we've seen in the last 12 months, but that's typically been the case.
Got it. Let's hop back to Orlando real quick. You mentioned South Florida or South Orlando, where you're seeing a deal. What was it, $245 a door?
$255.
$255 a door. Okay, got it. So, when I had deals down there, we actually had a deal that bordered Disney, and really for the longest time didn't see any kind of attrition or any kind of concern occupancy wise post COVID. We thought that would be a big issue. Are you hearing anything? Let's say in the past few months, it's been kind of drawn out with COVID.
Not down here.
No,
not down here. So look, there's some financials, there's going to be some bad debt on the books if you're looking back 12 months. But if you're looking at 90 days trailing, very little bad debt, maybe a few, most of it is probably, concentrated in a handful of tenants on any given property. Our economy has effectively been open with the exception of the first 60 days, the entire time. You talk to people that come down here from other states and they say it's like being on a different planet, but it's been good from a business perspective. Regardless of what your politics are, we're open, we're running our business. People can live and function. And fortunately, people are paying rent, which is good for our business. And we're seeing record numbers. That deal that we're closing on is a record-breaking number for Osceola County. I'm sure it'll get broken again in 2 months, but for the time being, we're the record holder, so we'll talk about it.
There you go. Yeah.
On the Orlando stuff, real quick, I was just going to ask: do you see buyers like underwriting that sort of? Because the same way that people underwrite Houston as sort of like having an energy concentration, do people underwrite Orlando different than, let's say, Tampa right now in terms of that concentration risk in terms of employment now post-COVID?
If they do, they're not going to win the deal.
Okay.
That's just the reality. I think if we're talking about like the Class A space, we used to talk about it as like institutional, right? Well, as we've seen, the cap rate spread compressed to nothing between the Class C and the Class A space, you're starting to see a lot more private capital move into wanting to acquire Class A, because they're saying, well, if I'm going to buy a 4 cap on a 70s deal with flat roofs and the ACs on them, why wouldn't I just pay the same cap rate for a brand new deal coming out of lease up? And maybe, my growth looks different. Maybe it's concession burn off and organic growth coming out of the lease up or something like that. So to your point, maybe it's less institution and more private, but I think everybody who's looked at Florida objectively has said we're going to come out of this better position than just about any other economic market, and writing off whatever sort of hiccups to the operations as a moment in time and just moving on.
How would you say somebody who's trying to move up from, maybe they've done B and C stuff in the past, maybe 20 million, 30 million, and now they want to go to a Class A, which is great, but the Class A is 250 units and it's 200 a door. So it's a, $60 million purchase price.
Right.
And you're competing against a whole different set of people than you were competing on the 1970s flat roof deal. So what, as a broker, what advice would you give to that person who says, all right, I can raise the 20 million in equity. I can qualify for the 40 million in debt to buy the $60 million deal, but I got to convince you, the broker, to award me the deal. So what advice would you give to that person to stand out in that market?
Yeah, just be aggressive. Be aggressive on timing, be aggressive on terms, hard money day one. That's what we've seen. That's what we've done. Look, if I was a buyer, I'd feel a lot better about putting hard money day one on a deal that just finished construction than on an 80s deal, which we've seen, pretty consistently for the last several years. So, and then you're going to have to pay up, obviously, but everybody's doing that. So, making the seller's life easy and making the broker's life easy always scores points. So, this last deal, there was hard money day one, and we're closing inside of 60 days.
Right. And then and I don't know if you asked this question to the buyer, but let's say they're buying on a 4 cap. Is there residual or exit cap 4, or is it 4.5? Is it 5? Are people underwriting any sort of cap rate expansion, or are they just keeping flat?
Typically there's 25 to 50 basis point spread. That's how we underwrite our models internally. And then we obviously push our model out to the buyer and hopefully they'll adopt most of our assumptions. But that's typically what we're seeing. You kind of have to, on paper, to make the numbers work. I don't think you're going to hit any sort of IRR projections if you're running flat cap rates on the exit.
And then I always like to, I can't tour, we tour a lot of deals in Dallas, but anything new, exciting that you're seeing people do for amenities or any space in the Florida market that we can best practice steal for here in Texas?
So we've got a developer client who's doing like a food market in their properties. So it's kind of similar to what you've got at like a Courtyard Marriott or, any of the Marriotts you stay at, but it's key fob accessed, and then it's got a point of sale. So, it's got a camera. So, it's a little bit honor system, but they can track your movements a little bit, but it's right off the pool. So you've got, chips and dog treats and that kind of stuff. And, Johnny sits at the pool and has a couple of beers and he's a little bit hungry and he pays $6 for a bag of chips or whatever. It's a great, amenity on the tour. And it's also an additional revenue line item. And then, everything else is just blowing out the amenity spaces, outdoor kitchens. We see a lot of outdoor kitchens, green eggs now popping up more on properties, big TVs. I've got a client who's doing a project in St. Pete, and he's lining the pool area with 14 hammocks connected to the palms. So it's going to give it a real kind of resort, like Florida resort feel to it. So things like that.
All right. Clay, any more questions for Jeff?
Yeah. So on the underwriting front, and James, you kind of mentioned this before we started recording, in Texas, you might have hail damage and whatnot, which leads to high insurance. You have to figure that into your underwriting. Talk to us a little bit about Florida. What makes Florida unique when we're coming in and underwriting a deal?
Yeah. It's insurance is going to be the biggest one. Taxes we're point of sale. So you're going to underwrite 80, 85% on the sale price for taxes. Insurance is increasing. It's rapidly becoming, a bigger ticket line item. I mean, I think you're anywhere from 600 to 800 a door now, which is probably 25 to 50% higher than it was 2-3 years ago. People smarter
that being wind insurance, I'm assuming would
well, I'm just talking about the all-in number, but people smarter than me would have to tell me what's driving that, other than just the losses that have happened from hurricanes and whatever else over the years.
Got it. And if I remember correctly, I'm not sure if this is still the case, but if you're on the East Coast, say outside of 95, for wind insurance, you're not paying quite as much as you would if you're, of course, inside between the coast and I-95.
Yeah, that sounds right. We haven't done quite as much over along that corridor as we have on the Gulf Coast, but that sounds about right.
Got it. And one other question too, just kind of going back to where the institutions play. We obviously know they're going to be in the three large markets we've discussed. Do you see them in Tallahassee or Sarasota yet? Maybe Fort Myers?
Not Tallahassee, Sarasota, Bradenton. Yes, we're starting to see them in there. I know Starwood has gone into those markets. Fort Myers, not so much. That's still more, private capital type space, but they're definitely coming in on the Gulf Coast. And in addition to, the four major markets, including South Florida. I mean, they're always in South Florida, but yeah, we're starting to see them come into some of the, I guess the biggest thing is, are you adjacent to a major metro, right? So Sarasota, Bradenton are Tampa adjacent, basically. I mean, and depending on how you're trying to sell it, almost suburban Tampa, if you really want to look at it that way. I think you can start to look at, the East Coast a little bit like that. I mean, Melbourne is not far off from Orlando and kind of sandwiched up the coast between Orlando and Jacksonville. So you're starting to see some of those markets too, see a little bit more institutional capital, but they're geographically strategic to the major metros.
Can you take maybe for like people like me coming in from out of town, let's say I flew into Tampa, and where are sort of the major employment drivers? And then are there where is the path of growth coming out of Tampa? And then maybe we'll do the same for Orlando.
So Central Business District, obviously. USF is obviously, it's a 50,000, just about 50,000 student university. And that northeast part of town has a tremendous amount of education and medical jobs. You've got the Central Business District, which has a lot of financial services jobs. And then, path of growth is really going sort of north up. So there's I-75 and the Veterans Expressway that feed to State Road 54, which is Pasco County. So from a housing standpoint, there are a ton of units coming in, both multifamily and townhome, single family residential along that 54 corridor. And then as well, if you go over to Brandon, which is another major sort of job center, USAA, the big insurance provider, has a headquarters over right off the Crosstown Expressway from Tampa to Brandon. And then, so if you kind of go over to Brandon and then shoot straight down south, that's basically Southeast Hillsborough County. Markets like Riverview and Ruskin is kind of the next path of growth area before you get out towards like Lakeland, which what we're talking about. And then, of course, Pinellas County is the most densely populated county in Florida. St. Pete is really turning into a really hot little city market. And it's, I think because of it's right on the water and there's a lot of you're getting a lot of European capital coming to St. Pete more than Tampa. They like the walkability and the, the livability, kind of the lifestyle nature of St. Pete. And so there's a lot of capital coming over there, but we're growing all over our markets. Tampa's not seen as much condo development as St. Pete. We're starting to along Bayshore Boulevard, and Related's doing a project, and some other smaller developers are doing condo development projects. But the majority of the new condo stuff has gone in St. Pete, not Tampa.
So, Jad, you mentioned Pasco County, and it brought back a memory from about a year ago. We were under contract on a deal, and we were doing our due diligence. And you're exactly right. Ton of single family development up that way. A lot of growth with the completion of an interstate or a highway system going up that way.
Yep.
And when we dug in, we were really amazed at what percentage of renters were only there waiting on their homes to be built. So it was kind of a lesson learned for us. We went property to property and asked that very question, and it was a staggering number. And so it scared us off a little bit, but then COVID came along, so we dropped.
Yeah, there are some, I would say, some of the pockets where the single family housing cost is sort of sub 350, 400. I would be concerned about building luxury apartments in those pockets. I mean, at some point, people are going to flock to home ownership, which of course brings us to the most popular topic in multifamily is single family rental communities. And so, I would imagine we'll start to see a lot more of those types of products go into those markets where you still get somebody who wants to be a renter, but will want to live in a more, family style circumstance and look at those types of properties. And it's also really the only place that there's any land to build that product, because you're really building anywhere from 4 to 8 units an acre.
Yeah, I mean, I was listening to a single family rental discussion, and it was like, and the person was from New York, and she's like, "That's not happening here."
Wow, yeah,
it's like, yeah, I get it. It's Texas, it's Florida, it's Arizona. That's where it's going to be coming. So.
Yeah, we've got a 35 acre site listed in Apopka, which is suburban Orlando, and you can do 4 units an acre. We've been in the market for a week and a half, 2 weeks, and we're already getting a ton of activity and offers coming in, and everybody's really, really hot on.
So I'm not a big development person, I guess you could say. So if you when you're looking at a piece of land like that, just give us maybe like a 1 to 2 minute how developers are looking at it and how they determine how much they can pay for that piece of dirt at a high level.
Well, everybody, all developers are trying to underwrite to a 6 yield on cost.
Okay.
Frankly, this thing is zoned for max density at 4 units an acre. If you wanted to try and rezone it, you can get up to 10. I think we're going to get competitive offers without the rezone. So we're probably not going to have to entertain that type of an offer, but you're trying to underwrite, the developers for them to take on the risk. They're trying to underwrite to a 6. I think increasingly it's becoming a high 5. And then you're, projecting an exit in the low to mid 4 cap. And that's where you get your spread. For us, determining the viability of a site is just like determining the viability of any sort of multifamily project. What's the demand drivers, A, and then B, sort of what's the municipal allowances or restrictions behind the site. And then from there, you can say, yeah, we'll get some interest in this thing and let's push it out there.
So when you guys talk to a lot of sellers, what are their concerns, the current owners of whether it's land or whether it's multifamily product? What are sellers concerned about? And then what's stopping them from selling their property typically?
The biggest objection we get to selling is, I don't know what to do with the money. And other than telling them to go buy Wawas and CVS's, I don't really have a good answer for them. People like to 1031. It's not any, or they think they like to 1031. They're not very easy to execute, obviously, especially in a market like today's where the supply is so scarce that you're going to ultimately pay up to do that 1031. And then the calculus becomes, well, why am I selling this other property in the first place? Right. And the flip side to that is it's never a bad time to take profit off the table. And there's a lot of uncertainty in our economy right now with, sort of the way money is being pumped into the system, I guess. So, will interest rates go up? I think at some point they're going to have to. We have inflation's coming. I don't know to when and to what degree, but I think it's inevitable. But then, counterpoint to that is if inflation's coming, a good place to put your money is in real hard assets.
Right. And then this is my last question. I think we're starting to see a little bit of light on rent growth here in sort of the major Texas metros. We look at a lot of T12s and it's been difficult sort of with COVID to push rents. And then we got that winter storm and, when your water's out, they don't want to hear that you're increasing the rent. So,
right.
I think this sort of spring, summer season, landlords are going to have a little bit more pricing power just with the amount of demand of people coming into our market. So I guess, have you guys started seeing rent growth in your markets? And what do you expect sort of in the next 12 months?
Yeah, we are seeing a lot of rent growth. We've actually seen, it was kind of stayed depressed last year. A lot of property managers and owners didn't really want to rock the boat. Let's just, keep everything stable. But I'm hearing anecdotally some owners are telling us that they're getting 10% on renewals just organically without doing any sort of a value add. We are back to underwriting our typical 3 to 4% annual rent growth across our major markets. And we don't see any reason to stop that. The one thing that we've talked about this, I think before we started recording, everybody's coming to Florida. We were projecting significant population growth before COVID started. I think it's only accelerated. I've heard, the numbers we've always talked about is 1,000 people a day. Since COVID, I'm hearing, upwards of 2,000 to 3,000 people a day, which would be 1 million a year. People want to be where they can go do, maybe not everybody, but a lot of people want to be where they can still go out and go get a bite to eat and feel free. And, there's a lot of jobs coming in and a lot of business moving to Florida. And it's been eye-opening to see the reaction to, not just the pandemic, but pretty much, the economic growth down here. And then just the amount of people wanting to move down here in the last 12 to 18 months.
And can you tell us about maybe some of the listings you have out right now and maybe some of the deals that you've closed this year already? Well,
so this market is a lot of deals are getting done off market in Florida because by the time you have presented a BOV, 5 offers have shown up on the owner's doorstep, and which is, it's a little bit like the wild, wild west. But I guess once you kind of see that that's the way the market's operating, you just
you pivot to that game because you lose enough times. You change the game plan, right?
Yeah, that's right. We can play any game as long as we know the rules. We'll get in and compete. We've got some, our firm has always been, I guess 80% of our business is focused on the private client space. So kind of the $5 to $20 million deals. And then maybe the 20% of our sales are really at that, call it $30 to $60 million range. We're seeing, more merchant developers more excited about exiting early and more capital being willing to finance those 50, 60, 70% leased up deals. So we're trying to engage more in that business. But we've got, 55 units listed in Avon Park, Florida, for example. We've got a couple deals coming in the south, along the Gulf Coast that are in the $15 to $20 million range. So we really kind of run the spectrum, and luckily our platform and our firm is diverse enough where we have great relationships with the guy who's going to buy a $10 million deal and the guy who's going to buy a $60 million deal. We've also sold more land, I believe, than most of the multifamily investment sales groups in this cycle throughout all of our offices. And so we've got, mentioned the one land site, we've got another one under contract in suburban Orlando. And that's been a very good way for us to develop relationships with developers also. So a lot of deal flow, some of it behind the scenes, some more hitting the market in the next, 90 days, I guess. Stay tuned and give us a call, and we're happy to engage on either what you want to buy or, hopefully what you want to sell.
Clay, any final questions for Jad as we wrap up?
Last question. If I were to dip into my savings account and hand you $30 million and I wanted to buy a multifamily deal for, let's say, a hold of next 10 years, of the markets that you cover, where would you put my money?
Tampa.
Versus St. Pete, or just Tampa in general?
Tampa, but anywhere in the Tampa Bay MSA.
Good deal. You picked one of my favorite cities in the U.S. So good job.
Okay. So cool. Is it because it's diverse enough to have sort of stable cash flows, but then it's close enough to everything else? Is that the thought process? Or
we've got financial services. We still do have some tourism. We've got medical. We've got a pretty diverse economy. We're coastal. It's still relatively affordable compared to Miami. And when I moved here 15 years ago, it was just a warm place. And now the quality of life and the things that our river walk has been activated. There's really great things to do on either end of the river and all along in between. And there's just a lot more waterfront developments and sort of amenities and life, and just the lifestyle, the quality of life in Florida is fantastic. I came from Cleveland, Ohio, and I love Cleveland. I'm still a huge all things Cleveland sports fan, but the quality of life in Florida is fantastic. And I think, people are, as human mobility increases, I think people are just starting to say, well, we're just going to go somewhere where we don't have to shovel the driveway anymore.
I love it. I only had to shovel the driveway one time, but this year, so it's not too bad in Dallas. But Jed, what's the best way for people to reach out and learn more about you guys in Florida and also more about your firm?
Yeah. So the capstone-companies.com is our website that has all of our information and, all of our listings, and just, the best way to kind of reach out to myself and really anybody else in our firm. Myself and Alex McDermott, who is one of the partners of the firm, and he's based in the Charlotte office. We also host our own podcast. It's the Multifamily Method. I believe it's on all the places that you can download podcasts. We're just getting started. We don't have nearly the audience that you guys have. So I appreciate you giving me the opportunity to sort of plug us on here. And then, if you just, anybody interested in learning more about Florida's markets or any of the other markets that we covered, that's probably the best way to find information on us.
Well, Jed, I appreciate you coming on. I learned a ton. I want to go to Tampa now. So appreciate you being there and selling a bunch of multifamily there. So we appreciate you coming on and educating us, and we will talk to you soon.
Thanks a lot, guys. I enjoyed it.
Thanks, Jed.
See you guys.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.